Well, in this session, we're going to talk about market timing. Long-term returns have a massive impact based on the timing decisions when you're going to get in, if you're going to get out, whether you're going to pay attention to it, or if you're just going to sit still and let time run its course in the market, assuming that bear markets never last all that long and you'll survive them. My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So one of the questions that's probably the most frequently asked when somebody runs into us and finds out we're money managers is now a good time to be in the market?
Yeah, that's a good one. Yeah.
Which discloses the fact that they're not in. They've got cash. They don't know what to do. They're afraid to make the decision to
Correct.
pull the plug, so to speak, and get started on it. There is no such thing as a perfect time to enter the market. In retrospect, there is, because you know what day the market actually bottomed. And if only Ida is the most common refrain.
Yeah. There'll be 50 talking heads talking about, well, of course, this was the day to get in. It's clearly that was the day to get in, even they didn't. They're going to talk about it later. But in the midst of the daily market turmoil, nobody knows what that day is until after the fact. Like I said, Don, only looking back, 2020 hindsight, never in the midst, unless it's just an absolute guess. And but that can keep people out of the market. So it's not perfect, so I'm not getting in. It's a big mistake. It's never perfect. As long as it's good enough, you have to go with that. Never let the perfect get in the way of the good. Don't look for perfect. It's never going to be there in the markets.
So there's actually a couple of caveats that go along with that statement, because one of the things the financial services industry exists to do is to convince you to invest whatever money you have now to put it in the market, because we manage money. We'll take care of everything for you. Don't worry about that. Not that they're going to avoid a bear market, because most managers simply ride bear markets from the top to the bottom and tell you, but markets always go up. It will recover. It just may take you a decade or two to get there, which is what happened after the tech bubble burst in 2001. I mean, you had to wait till 13, 14 years to actually break even. If you held your nose, closed your eyes, and didn't look at your account, you just held on and waited for it to recover. And even after the 08-09 housing crisis, mortgage crisis, it was about 7 or 8 years. Most people's emotions don't let them do that. So how do you handle that decision? And that's one of rules and discipline, which we talk about a lot on these podcasts. If you've heard us on others, that's not a new subject to you.
Correct.
You have rules and process. You have to rules, data, and process, because one of the things you'll be told is you can't time the market because you'll miss out on the best days of the market. They don't tell you that those best days happen at the very bottom of nasty bear markets.
Right.
It's also helpful if you could miss out on the worst days of the market, but nobody wants to talk about that, though. We have a podcast that does address that data. You're better off basically making a decision and having some awareness of what you're going to do with your investment capital. But overall, if you have a process, you're going to continue to stay invested. So maybe the U.S. market is collapsing. It doesn't mean that everything that you could invest in is collapsing. If you're keeping track of your choices, perhaps you would find that commodities, gold, precious metals, are doing well while the stock market is doing poorly. Or international developed countries, though they're more tightly correlated to the U.S., or emerging markets, or bonds. Just because you're going to invest doesn't mean you have to own everything all the time, but you probably should be invested in something all the time.
It should never mean that. It should never mean that. But you have to be willing to look at those things. And if like you said, on emerging markets, if they've been doing poorly for 4, 5, 6, 7, 8 years, people tend to start to write them off and they stop looking at them. And we're always saying, hey, those aren't in our portfolio right now, but we're always looking at that. Commodities, gold, long time gold was not in our portfolio. And then earlier this year it was because it was doing well. So you don't write them off. You have to keep tracking those out of favor sectors, and you have to be willing to make that change when they stick their hand up and say, hey, you know what? We're doing well right now. And you can't say, well, but you haven't done well for a decade, so I'm not going to invest in that. It's like, nope, things change. It's very dynamic. And when they do, you need to own what's doing well. And the opposite is true. If large cap tech has been saving your portfolio for a decade and a half, that's great. If all of a sudden it's terrible, you don't just sit by and say, well, I'm just going to lose all my gains now because this was really good. You have to be willing to make that change. And people get stuck in their ways. And it's like, well, it was so comfortable when the Magnificent Seven was fixing all of my problems. It's like, yep, it covered up a lot of ugly stuff, but it never stays that way. It never stays the same. It's always going to change. It's always going to need adjusting. And you need to be, number one, tracking the data so you can see what you should be doing, and then have the discipline to go ahead and do it, even though you're not comfortable with it.
So we have to ask, what's the underlying flaw that causes people to throw away good opportunity? And I would
Sure.
argue that it's because they're looking at long-term average returns.
Oh, that's a big one.
And we have clients who we would classify, who they themselves classify as gold bugs. They're
Sure.
absolutely committed to the collapse of the United States dollar and a future bankruptcy, and the gold is going to be the only asset that will have any value at that point in time. But
Correct.
but they have held gold through more than a decade of negative returns. They don't care. In their opinion, they will eventually be proved right. But instead, as we look at it, we look at shorter time periods. And when gold actually starts coming off of its bottom and moves up to the top of a performance list of assets, it should
Right.
be in the portfolio. The
There you
same
go.
would be true. And if that's the case, then that's a flag that says you need to start looking at similar assets in your portfolio, like silver or platinum or even nuclear, which is, it's an energy commodity, but it has had new global interest as we've found the difficulties that exist with wind and solar. So it's a function of what's working in today's marketplace.
Right.
It, if the Magnificent Seven has lost its glow, its magnificence of recent this year,
Right.
um,
Right.
because other things became so undervalued and Mag Seven became so overvalued. It's where do I get the most bang for my buck? And if enough investors start making that same decision, what you find is that other asset on a basic return calculation starts outperforming, and you need it in your portfolio. That's
Correct.
big money managers do this, hedge funds do. It's called sector rotation.
Sure.
This sector isn't working and that one is. Let's move our money. That's a
And the only way
rational
that works is
decision.
if you're tracking that data. You have to be watching those numbers to say, hey, you know what? These mega cap tech companies have been absolutely solid gold for a decade, and now they're not. So what am I going to do with this? And instead of just freezing and letting your gains run away because you're afraid to make a move, just take a look. What's going up? Where are things? And all of a sudden you notice, well, maybe precious metals is increasing, maybe emerging markets is increasing, maybe small caps increasing. Wherever it is, be willing to go there because that's what the data says, not because you've predicted the future. We don't believe in being able to pick the next big sector that's coming up. We think that's a fool's errand. You're never going to get there, and if you ever hit it, it's going to be just luck. And luck is not a strategy we like to employ. But if you're going to follow the money, follow the momentum, where are people heading with their dollars in the investment market? That data you can track. Do it, and then when you see a trend that's formed and is occurring right in front of you, believe it. Say, okay, that's actually happening. I'm going to go there. Because when it collapses, which it will, as every trend does, you don't have to collapse with it. You're gonna wait until you get a trend that's in a downturn, and now it looks like it's taking hold. Move back out of it. You're not there. You're not there forever. You're never in any position for the duration of your portfolio. You're there as long as it's doing well for you, and as soon as it's not, you move on to something else that is doing better, and that's how sector rotation works. You don't just sit still, you don't take a big hit, and you stay in the strongest parts of the market.
And you'll be told when to do that. If you're assuming you're tracking a list of assets, a list,
Sure.
whether it's sectors or individual exchange traded funds or mutual funds, however you determine you're going to invest your money.
Yep.
As returns in a different sector start outperforming, that sector climbs to the top of your performance list. And you're going to find the one that has been strong is no longer the leader. It starts losing ground. That's just math. That tells you that times are a changing and it's time for your portfolio to rotate. Maybe
Correct.
not an all in, all out. Maybe it's stepwise. You
Sure.
have good gains, but at least take some of the money off the table. And if you can take your capital off the table and let your profits run because there's still some momentum in the trend, that's risk management. And you're waiting for confirmation that there's other leadership that's developing and has what we call has legs to keep going.
There you go.
That's process. That's not market timing. It's often called market timing by people who want
Right.
to disparage it, who want you just to buy and hold and not pay attention to your account. But that's not
And that's
why.
most brokers. Yep, that's most brokers. They're gonna hand you that pie chart. They're gonna say, "Hey, we've got this all figured out because of historic returns over the last 80 years," which of course are meaningless to what's happening today. The market changes rapidly, the economy changes rapidly, technology changes rapidly. Those need to be reflected in your portfolio sooner than, well, in 10 years this will be reflected, because then this will be a bigger piece of our average return over the past what will then be 90 years. It's like, no, that's way too slow, and mostly that's just to keep you invested in their portfolio. That's all they're trying to do. Make sure you don't move your money, and so they're going to give you the spiel of, no, just buy a little bit of everything and hang on forever. That you don't have to do that. You don't have to own assets that are losing money and leave them in your portfolio indefinitely. When we take something out of the portfolio, it doesn't go into the trash can. It just goes onto the back burner, and we just keep watching it until, hey, it's perking up again, and it's going to be time to rotate back into that at some point. So it's not a throwaway situation, and it's not a, well, goodbye, we'll never see you again. It's just, you're going to get back in the portfolio when your performance is at the top of the list instead of at the bottom. And it really is that simple. You can really do that.
So how do you get this done? The if you have to make a self evaluation. Do you have a modest portfolio? One of the easy ways to manage the money and manage the sector rotation is with exchange traded funds. You
Sure.
can find a large variety of exchange traded funds with reasonable to very low cost. Index funds are cheap today. The two cheapest providers are Schwab and Vanguard.
Mm.
BlackRock has some cheap expense ratios on some of their funds. But personally, Larry Fink has some weird political opinions that show up in his portfolios. That's my personal opinion, and we do use one BlackRock fund in our 401k models, but we've eliminated all of them because of the um, some of the political bias that overrides those portfolios. And we don't find that at Schwab or in Vanguard. And there's other funds, companies.
Sure.
There's a ton of them around. You can be target specific on a sector. On actually some of the higher risk ones, you can be target specific on expensive individual company stocks today that are available in
Yep.
an ETF format that are a little easier to buy.
Bye.
Money
Sure.
money flows have supported ETFs, exchange traded funds, well beyond anything the industry thought was going to happen. and it has
Absolutely. Yep.
disrupted the traditional mutual fund industry beyond their um, beyond their fattest paycheck. Let me put it that way,
Correct.
because
Correct.
as they've lost assets, their revenue has decreased significantly. Uh,
Much to the benefit of investors, right?
yeah, and if you're buying individual stocks, you can buy these on a commission-free basis. The places that go to buy ETFs commission-free. There's hidden cost in there, but they're really marginal. They're not ones that are going to upset the total return on your account. The return on your account is going to be determined on will you be in the market in something.
Right.
You need to be invested almost all the time with all your money, all your risk asset money. If you need help doing that, we're an option. We'd be glad to talk with you. Send us an email or give us a call. Subscribe to our podcast. We have more information coming. Thanks for being with us today.